Aaron, with what while Aaron was talking, it was just what I've been watching is as he was talking about corn. Uh, Corn has started to really influence beef cattle prices more this fall than what we have seen in the past several years. And so just keep that in mind as we go throughout uh, all this. And so the big stories remain the same. We still continue to have this volatile price. If you've been keeping up with markets in the past 2 months, you'll see where we did have the October low on these calf prices, and those calf prices have started to rebound. But at the same time, feeder cattle prices have not, in the cash market, feeder cattle prices have really not made any moves over that time period. And it's has a lot to do with the fact of how expensive it is to feed cattle. Uh, the drought continues to influence our heifer retention and our cow slaughter rates. Uh, that's that provides the fact that we've killed so many of those animals or slaughtered so many of those animals is what provides so much optimism to cattle prices in the coming years. Um, I look at margin operators. Uh, Aaron mentioned operating loans, and for good, bad, or indifferent, if you're purchasing cattle, whether that's a stocker operator or a feedlot, all those people are going to have more capital available to purchase these animals. And if you're having to borrow that money, and even if you're not having to borrow that money, you have to assume that if you have that money, that you have an interest rate that you could be uh, charging to that money, and so that's going to increase the cost further the more money you have to borrow. So with that, we'll look at it from the standpoint of finished cattle prices are at their highest level since 2015. They've been kind of stagnant the past couple of 3 weeks, but the fact that we finally got back to 2015 levels at 150. Now, granted, the record price on slaughter cattle prices is 171. We're a long way from there, but it's not out of reason that this market could go back to that level at some point. Very easily could hit 160 in the spring. And as we look at how heifer retention evolves and how cow slaughter continues to evolve, those two things will really influence what we see on these slaughter cattle prices. And so as we see these finished cattle prices increase, if we continue to reduce this herd, then we're probably going to see uh, a higher ceiling for finished cattle prices. Now, we do realize that there's been a lot of moisture that has come across a lot of the drought-stricken areas, but what we also know is that a couple of inches of rain doesn't cure drought issues overnight. So just keeping that in mind. Here's what where we were with our 500 to 600 pound steer prices. So mainly our weanling cattle prices, and as you can see, they've started to bounce back uh, in the first few weeks of November and late October. But frankly, they weren't ever really bad. To see a 550 pound steer trading at 160, most of our producers were probably pretty tickled with that. And I do think these cattle prices are really going to escalate in the spring as the demand for grass cattle becomes very, very strong. Again, that's assuming that drought does not persist. Uh, the one thing that did put a little pressure on this was the fact that wheat grazing country did not have enough moisture to provide any fall grazing. Will they have any winter or summer or winter or early spring grazing? That's yet to be determined. Um, but they have received some rainfall. If you saw where a lot of these big systems move through that Nebraska, Kansas, Oklahoma, and northern Texas area. Again, like I said, the yearling type cattle prices really hadn't been doing much. If you go back and look at some of our low lot prices, they've been pretty stagnant. Uh, Not much to say one way or the other. But again, you got feedlots. If they're borrowing money, it's whatever they can pay for your cattle gets knocked back just because of that increased interest cost that they're seeing, the increased input cost for feed, energy, because we have to realize that yes, sure, cattle is their highest cost, but the feed and energy costs that go into an operation like that are tremendous as well. And now the cost of capital is continuing to increase. It's pretty eye opening with the little chart that Aaron showed going from $11 to $25 uh, per acre on an interest charge in his example. So that's eye opening from that standpoint. But the same thing holds true for these cattle. You've essentially seen uh, that interest charge double on those animals. Uh, I I think there should be a lot of optimism in the slaughter cow market moving into the spring. We had really strong prices all year. We've dipped down into our lows this time of year, which is not unexpected. But as we go into the spring, and if again if drought subsides and grass is growing, people are going to be holding back these females very strongly, and so we could easily see uh, exceeding $90 per hundredweight or 90 cents per pound in the first 4 or 5 months of the year. May even rival that dollar mark at some point, just like we did back in 2014 and 15. So here's what that slaughter looks like. The heifer slaughter is up nearly 5%. Beef cow slaughter is up nearly 13%. So I feel certain that what we're going to see is probably a 3% decline or better, maybe even up to 3.5% decline in our cattle inventory due to this tremendous heifer and beef cow slaughter. These numbers were over 5% and over 13% for heifers and beef cows respectively uh, prior to this month, but uh, we have to realize we've moved so many of them that we can expect these numbers to decline slightly, and might be, heifer slaughter by the end of the year probably be 4.7% above a year ago, and beef cow slaughter maybe 12.5% or so above a year ago by the end of the year. And the fact that we just keep on pushing these animals into that arena of slaughter, uh, we moved them so early that this time of year there's not nearly as many of them as what we would typically have. That increased slaughter is increased beef production. Pork production is down. Broiler production is down. The main thing about this beef production situation is, increased production has supported having more meat to export. But in future years, as we reduce the slaughter rate because we're trying to regrow the herd, just expect exports to decrease. As Aaron was talking about our export numbers in corn being down a little bit, when you have a lower production in a year, a lot of times you can expect lower exports of something. And so as we look at it from the standpoint of an expectation of lower corn production in this marketing year, we would expect lower exports of corn because it has a high value use here domestically. That's going to be the same way with beef. Uh, we're going to see a reduction in beef production, and so therefore, sure, there's going to be some strong exports to some countries because that demand is that strong. But we have a very strong domestic demand for this beef, and so we're going to see those exports decline and probably see imports pick up. So that kind of leads us into where we are. These beef and veal imports have been down compared to a year ago since May. Uh, is that good, bad, or indifferent? It doesn't. No, it doesn't. It's none of those. It's just the fact that we've been producing so much beef. we've harvested so many of those slaughter cows that's where we've got a lot of this lean grinding beef that we need to fulfill the demand that our consumers have for lean grinding beef. In other words, hamburger for the most part. And that those values will pick up once we slow down on this cow slaughter. Uh, that just it's just guaranteed that we'll have to start trying to import more lean grinding beef uh, in the near term. Now, our probably our largest import source is Canada, but from a lean grinding beef standpoint, Australia, New Zealand, we started bringing in some product from Brazil. That will probably again that the Brazilian market will probably again support be in that import mix quite heavily in the first quarter or first half of next year. Exports did fall off a little bit in September. Not a whole lot to say there. Nothing that impressive or not impressive from that standpoint. Uh, but just again, expect as we reduce production that exports will decline for beef. Just like if we have increased chicken production, more of it's going to go overseas. We've when we get down to what if you've been reading much uh, as it relates to the consumer and beef, there's been tremendous concern. A lot of people talking about the ability of consumers to purchase uh, beef. Their willingness to purchase. Are they trading down to lower valued products? Uh, there is a concern there. I mean, because as you see inflation increase, as you see interest rates increase, uh, I saw an interesting graphic yesterday related to uh, how many borrowed money, as far as where our money is. And of course, mortgages eat up the biggest part of borrowed money, especially as we've seen house prices increase, but also the increase in delinquency on payments, 90-day delinquency on loan payments. So not necessarily in mortgages as much as other things, uh, but we have a lot of people that are operating on borrowed money as consumers, and with inflation and interest rates increasing, the ability to refinance their home mortgages to reduce their monthly payments is going to be a difficult thing. Uh, Increased purchase or increased cost of other consumer goods, reduce the amount of disposable income to purchase beef. Uh, but what we still have seen is a very, very strong demand for beef. So it has softened a touch, but it's still very strong relative to, 2 or 3 years ago. So we shouldn't be concerned about that as much as maybe as what we have been. But as we watch these wholesale beef prices, the packer still wants to make some money somehow or another, and so that's going to drive that finished cattle market to some degree. And so we still do need strong movement of beef to hedge our bets on these cattle prices. Just, I mean, it's amazing what the drought monitor shows here. Absolutely atrocious, terrible. Um, when you're looking at 90% of our country, and really the part of the country that does the most production of our food, being in some form of drought or dry conditions. Uh, this has just been the story for us all year. I mean, if you look there at Tennessee, it was like, well, it's not too terrible. But I think some of us realize that in certain locations, we feel like we're in those reds and dark reds at times, and not just a slight drought. Because I know I was walking as I was checking some cattle yesterday. some ditches that would typically be running water by now and that would run water through April have yet to start running water, uh, which makes some management decisions for our cow-calf producers a little different on being able to have water and where their grass is, if they have grass. So that's just that's just an added challenge that producers have as they try to make their management decisions. Corn prices continue to be very, very high. Uh, I know that corn prices are actually lower today than they were back when I was harvesting corn, um, but they're still expensive. It's costly to feed cattle. We think of that from the feedlot standpoint primarily, but also from this here at home, as we've got a lot of people that will supplement, add a little energy with a purchased feed to their ration. It kind of stretches out their hay. If they're backgrounding calves, is the difference between feeding 8 pounds a day or 4 pounds per head per day because of feed prices, and of course they remain elevated because corn prices remain elevated. Not a whole lot to say about hay prices because it's a very regional market, but hay prices remain elevated. Uh, not only because of our short supply, but just increased input cost. It costs a lot more to produce hay this year, just like it costs a whole lot more to put a crop in the ground and more to buy cattle and just all around. That's the kind of situation we're looking at. So when we look at what actually it has been costing, think about this is just using the focus on feedlots data out of Kansas, and to know that cattle it costs about $1.12 per hundredweight, or $112 per hundredweight, uh, for cattle that came off of feed in January, relative to $131 or $132 per hundredweight in September. We're talking about a huge increase in cost, and there's nothing that would show that those costs are going to decline in the near term by much at all. So when it's costing $1.30 plus to put on a pound of gain, uh, it these feedlots had to be getting paid $1.50, $1.60 per pound to make it worth their while to feed cattle, or to be aggressive in feeding cattle, I should say. So if we look at where we are, this is, I can't see the top letter, but I think it's January. Um, the January feeder cattle market, you go back to that August time period when prices peaked. I mean, that's when we actually saw our strongest cash prices for the year for yearling type cattle. Um, Again, we've lost a lot of that. Is there still some optimism that these feeder cattle prices could increase? There is, but there's a lot of headwinds. Those feed prices are one, consumer demand is another, and so there's just a lot of headwinds to push through. You can look. I think I've got April on here as well. Um, so we've got a little increase moving from January to April, but uh, we had August, September, October of next year trading around $2 or better. August is now under $2. I don't know if we're going to be able to reach those levels or not. From the feeder cattle standpoint, it may be pretty tough. Aaron was talking about managing some of your risk from now until the 1st of March for uh, your crop insurance standpoint. But we don't really have those types of options or alternatives uh, when you talk about crop insurance for the cattle industry. But I do think there would be a lot of advantages to managing some of your risk, maybe not on all the cattle, but on at least a part of the cattle, uh, because there's just too many dollars involved in today's market to forego or to take the risk on not making some money out of the operation. So with that, I have some pretty lofty goals here for the finished cattle market. You know, you look at that April through June time period, and it says an average of 152 to 157, which would put you around, you know, 154, 55 or something on average. But I do think there's an opportunity to get to 160, you know, somewhere in that March, April, May time period. You know, there will be a week or something or two that we trade near 160. But here's what we have for a forecast moving into at least the first half of next year for those 5 and 6 weight steers, those 7 and 8 weight heifers, and those 7 to 8 weight steers. That, you know, that there's a lot of optimism still in the market. You know, you think about looking at 7 to 8 weight steers trading near 180, 175 to 180 in March and April. So a lot of cattle that are being bought right now should be able to be sold for a higher price than what people are currently purchasing those lighter weight animals for. Or if you're trying to make the decision to background or something like that, there are some opportunities to make some money. But if you look at those 5 to 6 weight steers, I've got them tipping $2 over there in March and April of next year. And that, I think that would get a lot of people excited from the selling standpoint. But again, it's just, it again points to a higher input cost for a lot of those that are buying these cattle.